Enron was once one of the most powerful companies in America, a Wall Street favorite, a symbol of innovation, growth, and success. It started as a traditional energy company, pipelines, natural gas, and steady, predictable business. But leadership wanted something bigger. They wanted Enron to become a new kind of financial powerhouse. Executives believed energy could be traded like stocks, bought and sold on a screen. The idea sounded revolutionary. Investors loved the vision. Money started flowing in fast. Enron expanded quickly. New markets, new deals, new opportunities everywhere. The company began trading electricity, gas, and contracts across the entire country. Leadership pushed the idea that Enron wasn't just energy. It was the future of trading. The stock price kept rising, quarter after quarter. Confidence kept growing. At its peak, Enron was worth tens of billions of dollars. Executives became celebrities. Jeff Skilling, Ken Lay. They spoke with certainty. They promised growth. They promised innovation. But inside the company, the business was becoming far more complicated. To keep profits looking strong, Enron started using aggressive accounting methods. One of those methods was called mark-to-market. It allowed future profits to be counted today. On paper, the company looked rich, even if the cash didn't exist yet. Executives created partnerships to move debt off the company's books. Some of those partnerships were controlled by Enron itself, but investors didn't know. The balance sheet looked clean. The profits looked steady. The story stayed strong. Inside the company, some employees began noticing things didn't add up. Deals were complex, numbers were hard to follow, and answers weren't always clear. Still, the stock kept rising, and success made people stop asking questions. In 2001, the pressure started building. Analysts wanted more detail. Some reports suggested the company was hiding losses through outside partnerships. One executive, Sharon Watkins, warned leadership privately. She believed the company could collapse if the truth came out. At the same time, the market was changing. Confidence was starting to shake. Then CEO Jeff Skilling suddenly resigned, and investors got nervous. The stock began falling. Slowly at first, then faster. More information surfaced about hidden debt and off-the-books deals. The partnerships that once hid losses became impossible to ignore. Investors started selling. The price dropped hard. Panic spread quickly. Banks demanded answers. Analysts demanded proof. The story stopped making sense. Enron tried to survive. Executives promised everything was under control. But confidence was gone. And without confidence, the company had nothing. In December 2001, Enron filed for bankruptcy, one of the largest in history. Employees were stunned. Thousands lost their jobs. Many lost their savings. Retirement accounts filled with Enron stock became worthless. Investigations followed fast. Executives were questioned. Documents were examined. Arthur Anderson, the company's auditor, was pulled into the scandal. Files were destroyed. Trust disappeared. The damage spread everywhere. Some executives were charged. Some went to prison. Careers ended overnight. The collapse shook Wall Street. Investors realized how much had been hidden. It changed accounting rules. It changed regulations. It changed how companies reported profits. Enron became a warning, not just about fraud, but about belief. Because the story looked perfect. The numbers looked perfect. The company looked unstoppable. But underneath the surface, the structure was weak. And the risk kept growing. When reality finally caught up, everything collapsed at the same time. Enron wasn't the last company to fall this way. And it won't be the last. If you want to see how other empires collapsed, watch the next episode of Boardroom Fallout. Another breakdown is already waiting.